Hello, welcome back, guys. I hope you had a nice weekend. It was a pretty warm one for me over here, and I hope you enjoyed yourselves. In this video, we're gonna be talking about Meta. I haven't talked about the company since a while now, and I wanted to touch base with you on it. It's been quite some time since we last talked about it, and there have been things happening. Now, recently, the company had its earnings report. We did talk about this, but we kind of want to examine a few things in more detail here and see what the company is likely to be doing in the future and whether it's a good investment right now. Whether we do expect this one to be going back to its $300 level or so. Now, if we take a look at the 6-month chart here, you will see the company declining pretty much overall, declining every month. It has been going down and down from its almost 1-year high of $400 actually at some point. So will it be reaching that high again? We'll see. But what I wanted to take a look at first is first to chat a little bit about the Nasdaq. I mean, the Nasdaq in itself has been down about 20% year to date. If you take a look at the 6-month chart, it's a little bit of a better picture just because of the last month, pretty much. It has been growing a little bit higher. But overall, it at some point was down about 30%. Recently doing a little bit better, but still on the decline, on a very, very steep decline here for the Nasdaq. And as you can understand, when the Nasdaq is down that much, Meta is one of the companies that will be deeply affected. It actually correlates with the Nasdaq obviously quite a lot. Now, in terms of what has been going on, Facebook or Meta pretty much took on some bond debt, which is the first time Facebook actually takes on debt. Facebook, in case you were not aware, didn't have any debt on its balance sheet, and finally they are getting some, which kind of leaves you in a little bit of a balanced reaction here, because having a little bit of debt is generally speaking a good thing because you can use it to grow. But from a company that has been making a lot of cash, you kind of see a potential worry here in terms of financing and getting a little bit of extra debt because the company didn't seem to need that. Now, of course, again, utilizing debt can actually lead to a higher growth. And so I'm really not opposed to this, especially if it's going to be used to grow the metaverse, for example, which obviously it's a big bet for the company. Now, you will kind of see here that we don't know the exact numbers in terms of the debt that the company is going to be taking, but it's assumed to be at about $10 billion is what I was reading in terms of what the company is going to be getting. You will see here Bloomberg News Agency reported Meta may sell 8 to 10 billion in debt. We'll see whether it's going to be even more actually. But again, I'm not that opposed. The company has been making about like 90 billion or so in terms of revenue and quite a lot in terms of net income and free cash flow. So they can very, very easily handle this kind of debt here that's going to be added on their balance sheet. And also, this kind of debt can actually help increase the return on equity, which is even interesting because when you're taking more debt, when you're taking on more debt, you're actually decreasing your total equity. Now you have more total liabilities, thus increasing your return on equity if you're staying at the same net income pretty much. Okay, so in terms of Meta and what has been happening, you can see that we had a mixed Q2, but it's slowly getting better. A lot of emphasis is given on TikTok, which I wanted to mention here. Obviously, TikTok is a competitor for Facebook, although it's operating in a vastly different manner. And right now, it's a pie. Its advertising pie. It's much less than Facebook, almost to a negligible point. But it will be growing, and it definitely has stolen some of Facebook's advertising for sure. Now, in terms of what has happened, you will see here that Q2 results were mixed, ad revenues were stable in total, which is a good thing to see amid this current climate, actually, because remember, when the whole market is going down in terms of people spending, advertising is going to be hurt a lot, at least for a while. So this is something to be expected for sure. Now, even though Meta has been doing relatively well in terms of their financials, even right now, obviously it's not as good as it used to be. There is a downturn, no doubt about it. But remember that it's been down about 50% or more than 50%. And it's becoming a fantastic value, at least in my view. This is why I'm holding quite a lot of Meta, and I have talked about it multiple times. Now, in terms of TikTok is what I wanted to talk about, how TikTok is eating into Facebook's revenue and user numbers here. is an interesting point that I wanted to mention. Now here, Facebook's revenues are down and user growth has stalled. Yes, we do know about this one. Facebook revenue is down from what it used to be. But it's mentioned here that TikTok is the major cause of Facebook's decline. And is that really the case? Now you will see here that according to Bloomberg, TikTok's annual revenues were 4.6 billion in 2021. And they were expected to reach 12 billion by the end of 2022. We'll see whether that's the case. But as you can understand, this is still way lower than what Facebook is doing. Now, remember, this is 4.6 billion in 2021. And again, even if it reaches 12 billion, if we take a look at Facebook's revenue numbers here, you can take a look at it in our income statement. You will see that Facebook has been doing like 118 billion. So it's many times more. And there is a very important thing also to notice about Facebook and TikTok advertising. TikTok is always going to be a lot more about influencers, which is of course a vital part in terms of advertising. It helps a lot, and a lot of companies are actually based off of influencers. But Facebook is all about the groups and the synergies. And so by creating Facebook groups and advertising through them, you're finding individuals that share similar interests. And that's one of the core ways of doing proper marketing and proper business, business plans. Because you want to be selling to people that share similar interests. For example, if you want to be selling, let's just say, dietary foods, for example, or exercise materials, exercise equipment, you need to be advertising to this kind of people. And so Facebook, with its groups, for example, can actually attract all these people, which will be talking about, let's just say, dietary foods. And then you can sell through that and advertise through that. While TikTok is mostly about influencers and kind of selling themselves with their products that they want to pretty much promote. So it's a little bit of a different type of advertising, and both of them have merits. But at the end of the day, you want to be selling to the people that are actually sharing similar interests, because these are your customers and these are the people who actually want your products. Influencer marketing is also very important, but it's a little bit different, and it mostly tries to target like younger people and people who are getting influenced by obviously celebrities, athletes, and people of that sort. And again, don't get me wrong, both of these markets are important, but I do think that selling is more often than not about pretty much serving people in their own interests. So this is why I like Facebook's advertising more. Okay, so let's go back a little bit and take a little bit of a look now at the evaluation of Facebook, for which we have talked about some time ago. And we do know that we're expecting lots of things from Meta. It's the metaverse, they keep growing, but it was worth examining what has been happening right now with the company as they are, getting more debt, as we're seeing some issues from TikTok, some competition arising. We still want to see whether it's a good buy right now. And again, we have analyzed the company in videos in the past. Right now, we're sitting at an about 14 PE ratio, which is going to be going up and down a little bit. The stock has been kind of volatile recently. Price to free cash flow at 11.5, and outstanding shares that are going down, with the company actually buying back even more in the future. And the company, remember, was super solvent, no debt. And yes, some of its growth is going to be going down, but still, the company has been growing at a tremendous pace. And amid this current climate, amid a market situation when people spend less money, you will be seeing a decline overall in every company. And so, with Facebook pretty much growing at fantastic levels through the past, I'm confident that they will be able to, pretty much go back to this kind of picture when things normalize themselves a little bit. But the margins of the company have been pretty good. The return on equity is probably going to be growing right now as the company is getting more debt, as we examined, because it is the amount of net income that the company generates divided by equity. And when equity goes down by getting extra debt, this value will likely go up, as long as net income again doesn't plummet, of course. Now, let's just take a little bit of a look at the stock evaluation too, and just come up with some potential revenue growth that the company will have. We know that it is going to be going down, so if we are pretty conservative here and go like 8, 10, and 12% in terms of the growth that the company will be having in the next 5 years, that is, and net income margins, again, we can kind of assume that they're going to be suppressed a little bit, even though they have been doing pretty awesome in the past few years or so. Let's just say that the company will be doing 25, 29, 27 and 29, which is much lower than their average. It's way lower actually, but let's try that. And we're going to go with 90, 100 and 110 in terms of free cash flow margins here. An annual return of 13% is the typical one that I like to use. And if we hit calculate, everything is in the green here. And even though our net income margins were suppressed and our revenue growth is not tremendous, of course, we are still sitting comfortably within green levels here. This is why I feel like even at a high scenario of $300, which has a revenue growth of 12%, a net income margin of 29%, and a free cash flow margin that is about 30% pretty much, or 31 or so, if you compare it to the revenue, that is, then we're still sitting at a 300 level. That is a buy right now, more than 300 actually. This is why I believe that this is practically speaking a close that, if not a $300 stock right now, is very close to that. And I could very comfortably see myself buying this stock even at $200, frankly. It still seems that it would be pretty cheap at that level. And we're gonna be seeing, of course, what's gonna be happening, but this is, I feel, a stock to buy and hold for some years, and this is what I'm doing myself. But do let me know what you think about Meta. Remember to leave a comment, and also like the video if you did enjoy this kind of videos. If you do enjoy this kind of videos, and I'd love to see you around. And in the meantime, take a look at the video that I created earlier, and I'm talking about a company that is not very well known. It's called Solo Brands, but it's an interesting one, and I think it's an interesting video to watch for sure. So take a look at this one, and I'll see you in the next video, guys. Bye bye.